Hey guys, welcome to this week's Money and Investing Show. This week, as part of our Rapid Fire series, we are looking at the top 5 investment blunders. We've all made them from time to time. The key thing, like any mistake, is of course to learn from it. Plenty of things to take out of this. Most importantly, don't just take plenty of notes, make sure you take plenty of action. Hey guys, welcome to this week's Money and Investing Show with me, your host, Andrew Baxter, and as always, my offsider and co-host, Mitchell Laurential.
Thanks for having me on the show, Mr. Baxter. Now, topic of discussion for today. We've all made them, and they're called blunders. However, today, for the benefit of our listeners, we're going to head into the top 5 investment blunders so that our listeners can know what they are and then avoid them, a part of our Rapid Fire series.
Beautiful. Look, this sounds fun. And I think, to put a precursor on that, it's okay to make mistakes. And as the old quote says, the person that's never made a mistake has never really done anything. We learn so much in life by doing. I'm sure also with the benefit of reflection, sometimes we sort of think, I wish I'd approached that a bit differently. So that's really the sort of the blunder side that we're looking at. So it's by no means a criticism of people that have done things wrong. If you've done something wrong, let me know what t-shirt size you are, because I've got a whole wardrobe of those. But it's how you can avoid them going forward, which is the key.
Absolutely. And, people like yourself who have been around the traps for as long as you have made the mistakes for the benefit of people like us and people like me.
Well, another quote, and I don't want this to turn into a quote-a-thon, but as the saying goes, experience is a great teacher. It's a lot better and a lot cheaper when it's somebody else's.
That's right.
Okay, so let's get into it.
Let's get stuck in rapid fire series. So we're going to do a series of top 5. So top 5 investment blunders to kick us off. First things first, what about not starting early enough? That's a pretty big one.
Gee whiz, it is. And look, we talk about this in our book, the Wealth Playbook. We've also talked about this, several times through this podcast in different episodes. And the reality is, you just got to get started. Whenever you've made that decision, just get going. And there's nothing worse than leaving it late and then having to justify in your own mind that frustration of, I should have done this before. I just did an event last night. I was in a rural town in New South Wales, and you're talking to people saying, I wish I'd known about this 5, 10, 20, 30 years ago, and you can't turn the clock back. That said, once you know about something and once you've made a decision, get on and do it. It's all about taking action. And I think, as Tony Robbins, another quote for you, says, never leave the side of a decision without taking an action step towards it. So if you've decided that you want to get into the investment space, get started. Just get started. It's about moving the needle and building momentum. And that only happens when you kick off.
And you can get started small as well. And I think a lot of people forget that time is your ally. We literally had a chapter on this in your book, as you say.
Exactly right. And unfortunately, we carry an expectation, or a lot of people do carry this expectation, which is a poison chalice, and it's about setting the bar high. And it's good to have high standards, and it's about, okay, when this happens and when this happens, and then when this happens, I'll get started. I've got to wait for perfection, and perfection very, very rarely exists. You've just got to accept what it is and get cracking with it. And you can always wait for the next thing to be the confirmation before you maybe might think about getting started if the wind's not blowing in the direction that you want and you're still on one leg, or whatever the excuse might be. And again, excuses, you just got to shoot them and get rid of them straight away. Now's not the right time. Well, when is the right time? There's never a perfect time. The best time to start was yesterday, if not the day before. So you just got to get cracking, get your money working for you, get compounding happening, obliterate excuses, and just be absolutely wholesomely focused on just not accepting an excuse and actually only accepting action steps that take you towards your goal. Because every day you're not taking a step towards your goal, you're actually taking a step further away, because you don't get that time back. So just get started as soon as you can. I was fortunate with my stock market investing. I started in my teens. In my property investing, I started in my early 20s, and I kind of kicked myself that I could have started earlier. I probably couldn't, but my expectation on myself is, I should have done that even earlier, because then things would have worked even more from a compounding perspective. It's going pretty well, but you could always sort of grade yourself, I could have done that a bit better or started earlier. So where you're sucking on the bottle or being burped by your parents, I should be starting in property is probably a bit early, but you got to get cracking, that's for sure.
That's right. Message is clear on that one. Now, it's one thing to get started, but getting started and not knowing what you're doing is one of the biggest mistakes that we've seen so many of our now clients have made in the past. So number 2, not getting educated.
100%. The quote, lots of quotes in this one, isn't there?
Quotathon and analogies.
It is analogies, quotathons, and hopefully some substance around that. But yeah, the reality is the best investment you'll ever make is in your education, because knowing what to do and when to do it is key, and education is a massive, massive part of that. And there's so much you can learn by experience, by actually getting started and getting that first-hand anecdotal runs on the board of what to do, what not to do. But getting some specialist training to assist you in that journey, and maybe learning not to tread on the landmines. You think about crossing a landmine field, a minefield, which investing can be for a lot of people. The safest way of crossing a minefield is to walk in the footsteps of someone that's previously done it. And if there's someone that can educate you on the pitfalls and mistakes that they've made so that you don't make them, and teach you an easier way. That's not to denigrate your own personal experience. You still need to get experience for yourself, but avoiding some of those rookie errors are crucial. If you think about the stock market, and my first hit out in the stock market, well documented, I know, was a disaster. I lost all my money. It didn't put me off. I made sure I got educated, and look where it's led me. And I think, there are certain things that you can look out for. We see people start, I'll open a broking account, chuck some money in, which I hate that term.
Yeah, me too.
Remember the guy
throw some money at,
Remember that guy at the gym? I'm going to throw some money. You throw it at that, you might as well throw it in the bin. You've got to be a little bit more deliberate in what you're doing. I'm going to throw some money at this and give it a go and learn as I go along. And the only challenge with that is you will lose money, unless you're very fortunate with your market timing, and you won't actually know what you did wrong to lose that money, other than the stock market's a bad place. Whereas if you've taken a little bit of time to upskill and maybe learn a bit about analysis, or how news flow influences markets, or dividends and the impact they have, or strategies like covered calls, or whatever it may be, you would have tilted the odds significantly more in your favor. The way up then comes, we think, well, we have an education company, and yes, it's a premium business. You pay for the service that company provides. And oftentimes you'll see people that have got, substantial portfolios, $1 million plus of stocks and other assets and different things like that. Oh, I don't want to pay for education. And it's like, okay, well, if you could learn one thing, like, for example, how to use a stop loss, or how to buy a put option to insure your shares, on $1 million portfolio, if that saves you from, a COVID type correction of 25, 30%, or a GFC 35%, or a September 11, 40% dump, what's it worth to you? What's it worth to you? What would you pay to learn the skill to avoid that pain? And it's financial Panadol, being educated, because it helps you avoid the pain that you will otherwise have. So certainly getting educated in that way. If we talk about property, looking through a slightly different lens, again, buying things in the right entity right at the get-go, because if you buy a property, and median price in Queensland is about what, 800,000?
$850, I think, roughly.
850. We'll call it 800 just to keep the maths easy. You got me straight off the plane, so I'm not quite as sharp as I'd like to be. I've sort of blocked ears at the moment. So 800 grand. Let's say there's stamp. Let's say you decide this is in the wrong entity and I need to move it, and you've got to pay stamp duty on that 800,000. That's going to cost you at 2%, 16 grand of stamp duty
at least. Yeah.
If it's 3%, there's 24 grand, depending on what state you're in. And you look at that and you go, well, okay, if I'd have maybe taken on board a couple of $1,000s of advice, professional advice, or education on how to make sure I buy my property the right way, versus paying stamp duty, it makes no sense. But people don't see that. They see a cost when it comes to education as opposed to an investment. So can't stress it enough. As someone that's been at the front line of financial education in Australia now for 24 years, get started, get educated are the two key things, and do not scrimp on your education. It will save you thousands, tens of thousands, hundreds of thousands, even millions down the line.
Beautiful. Well said, AB. Moving forward now, number 3. Now, we know getting started and getting educated is important. What about number 3 is actually not having a game plan? A lot of people, any road will take them nowhere, right? They just jump in. They've got
Great quote.
Thank you.
A lot of quotes today.
I got it off someone who I really respect.
5-1, come on.
That's right. I'll get them in there. Don't worry. So not having a game plan, that can be very costly.
Absolutely. You've got to know where you want to get to. And, the analogy I've used plenty of times in the past is, you imagine if you're at a park or a new city, and you've got the big board, which is the map of the park that you're in, and there's the red circle that says you are here. That's great. But if you don't know where you want to get to, it's pretty useless. It just tells you where you are right now. You need to know where you want to get to, and then you can choose the route that's likely to get you there in the right way. And I use this example, I think I was in the States a little while ago. So, imagine if you're in New York and you need to get to a particular place.
Happened to me over Christmas in Central
when you were
Park.
There, exactly right. So here you are, you're there at Columbus Circle, you're in Central Park, you want to get to the other side, you maybe going to Guggenheim or something on the Upper East there, and you go, okay, I need to get there. How am I going to get there? Well, it's not just a question of drawing a red line across and go, that's the straight line, because number one, it's probably going to take you across the ice rink, which you can't really do. But number two, depending on the time of day that you're doing it, it might be getting dark, in which case walking across Central Park in the middle of the winter at night is probably not the smartest decision to make. Crime is on the rise in New York at the moment. So a different route to get you there would be, given the fact that it's now nighttime, would be to walk around the outside of the park. Far safer, more people, more lights. It might be that if you're totally risk averse and not good at navigating, getting into an Uber that drops you at the door might be a far better way for you to get from A to B. Or it might be, which I've done in my time, maybe you're a little bit more spirited and you're going across the basketball courts there and you want to shoot some hoops with some locals and hang out and have a great war story to talk about. That might be the path you take. The bottom line is the destination is the same, but the way you get there is very different depending on what your personal attributes are. And in the investment world, that's all about understanding particularly risk, because you can get to the same destination, but there are risky or less risky ways of getting there. So you have to have a game plan, part of which is to understand what your tolerance to risk actually is. Very, very, very important. Now that game plan will change over time too. It will evolve. And as you start to kick goals, which we've talked about plenty of times. Every January we do a great session.
I was going to say we're up to number 4, coming up to number 5 now, I would say, wouldn't we?
Yeah, we'll be our 5th year of doing that now for people. Those goals need to be revised. As you kick them, you want to set yourself another stretch goal so you can grow even more. And so you need to move that plan along. And if it's based on experience that you've gained and education that you've been taught and then started to apply to give you more confidence and experience, those goals will get bigger. And so the game plan needs to evolve in order to accommodate that. So having a game plan is crucial. You can't float on the wind and hope it's going to drop you where you want to get to. It's just not the way to get there.
Speaking of game plans, AB, one mistake that I've seen come to mind as number 4 here for us on the rapid fire would be being too one-eyed. Having a preference and maybe sticking to that family influence potentially in there.
Yeah, look, this is a really difficult juxtaposition for people in that if you've got a particular skill set and you're good at doing something, you're probably going to dollarize it well. That's the typical, if you read Jim Collins' book, Good to Great, what are you good at? What do you enjoy doing? And what can you make money at? And if those 3 things overlap, there's your business plan. So that may lead you down a particular pathway. And as you say, that can sometimes be influenced by family or friends that, we're a property family. That's the dynasty we've created.
We've always done property.
Yeah, or it could be stock market related, or it could be in today's world, online e-com. It could be a whole raft of different things. So that's our thing. And that can be very, very handy, and it's good to have that expertise, but it's also pretty important to diversify, to reduce risk. Now, I'm a big fan of saying if you stick to what you're good at, don't try and be a good all-rounder, be an expert. That's how you make great money. So if I put that coach's hat on for a moment and say, look, if you want to make great money, stick to what you're an expert at, because that's likely, inch wide, mile deep. That's where you're going to make your dough. The flip side of that argument is that there are reasons from time to time that you do want to be able to diversify out of what you're doing. One of our clients, I think of say Torb down in Adelaide, for example, has been very property heavy and is now increasing his exposure to the stock market. He's done very well from property. He's a smart guy. He's a great guy too. So it's good to see that level of success, but it's also good to see that diversification coming in. We've got another client who's coming in with a pretty heavy sum of money, as you know, over the next couple of weeks, where his business is, his area of expertise is better at it than anybody in the country, I would say. That's why he's made the money he has. And he's starting to port some of those funds into other stuff that we're doing here to give himself some diversification.
So, sorry, AB, just to stop you there, question for someone out there who may have a particular skill set in one area but wants to diversify into other areas. Is it a matter of outsourcing the decision-making, or at least the advice?
The challenge, where it becomes hard, and I think in the early days you need to outsource and you do need to get advice, or you go back to ground zero or work out what you want and get educated so that you're not approaching it with the same level of expectation. You see that if you're good at something and you start something new, you expect to be coming in at that level straight away. It's very, very hard to start at ground floor and build up again. It is important to do that, however, and I think getting external counsel, certainly helps with that. And we run our service through our financial advisory stuff, My Money Advisor, where we have your money advisor, your money coach to assist you on that journey. And specifically the sorts of things that might be there is that ability. Look, I'll lead the way, you follow as you build your experience up, and they take you down that pathway. They need to be an expert in their field. That's the crucial thing, I think, to follow. Now, you may argue, no, I'm going to stick to what I do best, and that's okay. But there are plenty of examples through history of people that have stuck to the knitting as to this is what we do and this is what we only do. I'll give you two examples of this. One is Fairfax as a family, which pretty much has gone from being one of the wealthiest families in Australia to no longer being in that position. Still very wealthy, but nothing by comparison, because they were in a very narrow channel with their business. They didn't want to go digital, for example, because they didn't want to cannibalize their printed business. And along come things like, realestate.com, car sales, which obviously was a Packer-backed business, or Seek, as opposed to looking at the careers section of the newspaper. We don't want to damage our classified, so we won't go online. And those businesses, multiples of what the Fairfax empire was. On the other side of the coin, you can also look at companies like Kodak, which invented photography to all intents and purposes, and in fact invented digital photography, but didn't want to move into that place because they didn't want to cannibalize their film business and developing and all that different stuff. And now it's effectively was bankrupted. It's come out of that now, of course. So that's an example where you're doggedly in your channel and refuse to accept there are other things out there. So you do have to diversify your thinking and look for new opportunities to spread risk. And I think also from your own personal perspective to keep growing, because, another quote for you, take it to 6-1, if you're not growing, you're dead.
Absolutely. Couldn't have said it better myself. Forward thinking, moving along, innovating is very important.
100%.
Last one for you, AB, and this might be a little specific, although many people do make this mistake. We see this all the time. No money maintenance plan. What does that mean, and how do you avoid it?
Yeah, look, there's a level of stewardship that's required with money, and this isn't just about the mega wealthy. It's what you need to do at every stage, and it's to tend the garden. So you may have planted a beautiful garden. You go, here we go, I've watered it, off it goes. You still got to get out there and weed. You've still got to get out there and prune and do all of the different things from a maintenance perspective, and money is no different. So we talk about this very specifically in the book, in the playbook, very, very specifically that there are tasks that are annual tasks. There are tasks that are quarterly, some are monthly, and some are more regular than that. So an example of an annual task might be looking at your finance from a property perspective, where you might be able to refinance at a cheaper rate. You think, there's a lot of work for that. But if you've got half a dozen properties, that's a $5-6 million property portfolio. And if they're pretty geared up, which most investment properties typically are, that's a $3.5-4.5 million loan book. If you can save 0.5% interest on that by going to get it refinanced, that's a huge saving.
We should do an episode on property blunders, the top 5s. There you go.
Only 5. I've done a few more than that.
Yes. We'll try and keep it into 5. Sorry to take you off track, but I reckon that'll be a good episode. Let's do that next.
Let's see what we can. This is rapid fire, so we're open to suggestions too from our audience if you've stuff you want us to cover. So going back to that, so a good example of that would be looking at your finance over the course of the year, reviewing your life insurance. Again, is it enough? Is it not enough? Those sorts of things are important. Quarterly, there are other things. Budgets, for example, is a monthly job, making sure you're staying on track with your budget. Quarterly might be where you're reviewing the performance of your stock market portfolio or your self-managed super, for example. So doing these at regular intervals through the year help ensure that things touch down where you want them to. We talked earlier about having a game plan. You might set the game plan out, but if you don't spend time monitoring and making sure the action steps, because you got started, this actually brings it all together. Your maintenance is making sure that you're on track with your action steps, that your game plan you've got is evolving to deal with what's going on. You're learning as you go along, and one of those things to learn is to make sure you keep maintaining the thing and keep it driving forward. So it's a very, very important. It's not set and forget. You've got to keep tending this. And money dates with your partner is also a very good thing to do, which we talk about again in the Wealth Playbook. These are core skills to have. Not doing them, because let's face it, in life, I'm going to take this to 7-1 from a quote. The easiest thing to do is to do nothing and hope things change.
Gotcha.
That doesn't work. You have to be affirmative with this stuff. And it's not becoming, you don't have to be obsessive about it, but you do have to pay attention.
Totally.
And I think, that's what most people fall asleep in the getaway car. They get all this stuff set up and they don't watch it closely enough. And as a consequence, it doesn't land where they want it to be. And that's a real shame. And that's a real blunder in itself. So money maintenance, very, very important.
7-1, as you said, AB. Rapid fire. I think we covered off plenty of substance amidst those quotes. Thank you very much for today.
My pleasure. Anytime, Mitch. there you have it, guys. Make sure you like, comment, subscribe. Most importantly, hit the notification button, and we'll look forward to hosting you next week.